The recent movements in the silver market have left many investors questioning what truly happened. This wasn't simply a price adjustment, it was a demonstration of how market structure, positioning dynamics, and leverage mechanisms can create dramatic volatility. Understanding the difference between fundamental changes and structural disruptions is essential for anyone invested in precious metals. When markets experience rapid declines, the immediate assumption is often that something fundamental is broken. However, in most cases, what actually shifts in a matter of hours is not industrial demand or supply fundamentals, but rather the positioning of market participants, their leverage ratios, and the liquidity conditions under which they operate. To properly analyze what occurred, we need to understand how futures markets function. In commodity futures, most participants don't pay the full value of their positions up front. Instead, they post what's called initial margin, a fraction of the total position value. Exchanges also require maintenance margin, which is the minimum account balance traders must maintain. When an exchange increases margin requirements during active trading, it creates an immediate liquidity crisis for leveraged participants. Imagine driving at high speed and suddenly being told you must slow down immediately. That is essentially what happens to traders. They must either deposit additional capital instantly or close their positions. Consider this scenario. Thousands of traders holding similar positions, many operating at maximum leverage, all receiving simultaneous demands for additional capital. This creates what market professionals call forced liquidation. Unlike voluntary sellers who can negotiate terms and timing, forced sellers have no choice. They must exit positions immediately regardless of price. This forced selling triggers a cascade effect. Initial selling pushes prices lower, which triggers additional margin calls on other traders, forcing more selling, which drives prices even lower. This self-reinforcing cycle can obliterate technical support levels that would normally provide price stability. The critical insight here is that chart failures aren't always thesis failures. Sometimes they're structural failures. The mechanism through which investors expressed their thesis couldn't withstand the pressure, even if the underlying thesis remained valid. A fundamental concept that many investors overlook is the distinction between paper silver markets and physical silver markets. These operate in different worlds with different dynamics. The paper market consists of futures contracts, options, and various derivative instruments. It's characterized by high liquidity, rapid execution, and substantial leverage. Participants trade claims on silver, promises of future delivery, and exposure to price movements, not necessarily the metal itself. The physical market operates differently. It involves actual supply chains, mints producing coins, refineries processing material, fabricators creating industrial components, and end users who need the metal for manufacturing. This market moves more slowly and responds to different signals. During calm market conditions, paper and physical prices track each other reasonably well. During periods of extreme stress, they can diverge significantly. Paper markets can swing wildly based on positioning and leverage, while physical markets continue grinding along based on actual supply and demand. Recent industrial usage data consistently shows that silver demand extends far beyond investment speculation. Modern silver demand stems from high-efficiency electrical contacts in electronics, soldering and brazing alloys in manufacturing, medical applications utilizing antimicrobial properties, photovoltaic materials for solar panel production, infrastructure modernization, and grid upgrades. This industrial foundation matters because it means price volatility does not automatically eliminate demand. Manufacturing facilities with committed orders and equipment requiring specific components cannot simply halt operations because paper prices fluctuated. This creates a demand floor that purely speculative assets lack. Understanding who wins and loses during forced liquidation events provides insight into market dynamics and future price action. Winners in these scenarios typically include short sellers who can cover positions at significantly lower prices, market makers who profit from widened spreads during volatility, patient long-term buyers who gain better entry points, institutions with cash reserves to deploy when others panic. Losers generally include leveraged long positions unable to meet new margin requirements, recent buyers using tight stop-loss orders, panic sellers who exit after significant damage has occurred, traders caught off guard by mid-trade rule changes. For those who utilized leverage, this event served as an expensive education. Leverage operates as a magnifying glass. It amplifies both gains and fragility. Even sophisticated investors get caught in cascades when exchanges modify requirements during active positions. Silver supply isn't infinitely flexible. Unlike some commodities where production can scale quickly in response to price increases, silver often comes as a byproduct of other mining operations. This means supply doesn't respond instantly to price spikes. When demand surges, supply cannot adjust immediately. This structural characteristic explains why silver markets can experience periodic squeezes and shortage conditions more frequently than commodities with more responsive production. Recent manufacturing activity and energy infrastructure development data indicate that demand remains more durable than many assume when focusing solely on price charts. Modern economies run on electrical infrastructure, and electrical infrastructure requires metals like silver. The electrification trend, grid modernization, and renewable energy expansion all contribute to sustained industrial demand. Investors in this plan capable of surviving market turbulence without forcing you into poor decisions. Several signals can help assess whether the recent volatility represents a temporary flush or a more prolonged adjustment. Do margin requirements remain elevated or normalize? Does open interest collapse and then rebuild, indicating renewed participation? Do physical premiums stay firm despite paper change the reality that modern economies depend on electrical infrastructure that requires metals? Global financial systems continue rapid declines, shake out weak hands, then markets eventually stabilize and rebuild. When these forces align, silver can experience explosive price movements. Recent years have presented an unusual combination turbulence. Consider this possibility as well. Perhaps nobody orchestrated this event. Sometimes large institutions simply analysis is provided for educational and informational purposes only. Nothing presented here constitutes financial advice, investment recommendations, or solicitation to buy or sell any securities or commodities. With invalidation.